Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Hey everybody, this is Sam Barker here with Aaron Kennedy and Kade Sparger today for the Black and White Market Minute on Life Planning 101. So we're going to touch base on a little bit from Kade's point of view, but I think that we're going to start off with Aaron pulling out his crystal ball and telling us when we're all going to be rich.
Oh, yeah. Fantastic. Always. That's a good introduction. No, I think it's kind of cool. We do have Kade with us. You know, we're usually just talking markets and economy and stocks and that kind of thing. But bringing Kade in to help us put it all together because, you know, investing is only one part of it. It's always funny because we're always trying to figure out what in the world to talk about. And I think today's pretty easy. I saw Fed Governor on the Waller on TV this morning, and he was talking about tariffs and inflation and jobs and everything else, and figured that we could just put it all together and show the big picture. It's funny, all the talking heads are just wrong about what's going on with tariffs and how devastating this was going to be. Seems that everybody was wrong. But I thought Waller today had some pretty good things he said, and it's really eye-opening. You know, if we just jump straight to tariffs. Tariffs are about a little bit over 13% of our GDP. And if you think about it, a 10% tariff is going to affect how much of our economy? 10% of 13, what is that, 1.3? If it's all passed through to the consumer. And we know that's not happening. We know that the suppliers are eating some of that, and it's not enough to move the needle. The value of the dollar is way more, but the tariffs should not be anything. We were talking last time about that we're a service economy, right?
Yeah. Yeah. Well, and services aren't tariffed.
Yeah.
You can't tariff a service, so
that would be cool.
Yeah. Yeah. Well, and what Waller was saying, you know, even if it moved the needle, what they've argued for the past 50 or 60 years is those one-time price shocks should be looked through and minor adjustments made, if any. So.
Yeah, it should not even, they shouldn't even pay attention to it. So I think we're all burnt out. We're all having to hear it all the time, but everything we do, everything we look, see, hear, it's all political. And it is affecting every part of our life, even if we don't want it to. You know, it's just that voice in the back of our head that doesn't stop. It's the tweet that never ends, you know. And this is I think it's a great learning tool that, hey, politicians and politics really don't affect the market over the long term. Not one bit. And we're seeing it right now. I think one of the greatest learning experiences that I ever went through was this exact lesson that I believed our economy was going to change so much because who is in office. And I'm going back in memory, this has been a long time, but I think the first year Obama got into office, there was a lot of talk about us moving into socialism. And you know, that didn't sit right with me. And I was trying to make investment plans of what happened if capitalism wasn't part of our way of life. And I adjusted our portfolios for it. And the market went through the roof. If I remember right, it was like a 30% year. And we didn't get that because I was more conservative. I think we still got into it was in low 20s. And I had this was back in the day, so I was interviewing money managers all the time. And I talked to a gentleman that ran a hedge fund, and he'd been doing it a heck of a lot longer than I had. And he was hammering me on, hey, investments climb a wall of worry at all times. There's always been a million reasons not to invest, and one of the silliest ones is politics. And I mean, it was one of the greatest interviews I've ever had, and it stuck with me. And this feels a lot of the same. So take it for what it's worth, but sometimes we just need to turn off the TV, quit listening to the talking heads, because a lot of them have an agenda, or a lot of them are speaking from the heart instead of the balance sheet. So.
Well, and I think to add to that is that anytime you listen to politics and whatnot, they really like to drive home the more negative aspect of what's going on with the tariffs and whatnot. They don't get viewers from the positive. People are less likely to believe in the positive piece of it, but if you spin it, in the crazy way to keep people kind of churning, it drives it up a little bit more. So
yeah,
if I remember correctly, I think that the more left-leaning news outlets got better viewings whenever Trump was in office than when he wasn't in office. And I think that the same is probably true for the alternatives point of view as well, where, whenever Biden or Obama were in office, I'm sure that Newsmax, for instance, Newsmax blown up over the past 4 years.
Yeah, isn't that crazy?
Yeah.
That IPO, how much did that jump like in 2 days?
It spiked up to $160 or $170, and I think last time I looked at it was around $13.
yeah,
I had more calls over Newsmax than almost any other IPO in history, and not even at the IPO time, but they were issuing some preferreds out there, and it wasn't even through broker-dealers or the normal channels. It was like you had to read it in the back of a magazine, or something like that. But I had lots of people calling on that, and it's just tugging at that heartstring of why people are interested. It's pretty crazy. So what can we learn and what can we do about this now? I ran into Sam's office today. And we pulled up our quality growth portfolio. And, if you ask me, we are holding some of the greatest companies on the planet. Notice I didn't say stocks. I said greatest companies. And where we look, we have this little line, and it's price action over the last 52 weeks. So it's kind of like a candlestick, but laying sideways. And we have a lot of companies that are on the bottom side of that candlestick that are just extremely cheap from price standpoint. And, a lot of them are cyclical. Some of our trucking companies, anything that's really pushed by the economy, it doesn't look fun. I guess that's the easiest way to look at it. But just like what was going on in April, I'm very, very excited. I'm looking for money, because prices don't stay low forever. And when you get these opportunities, you really, really have to take advantage of them. Looking at S&P earnings, we visited on this a couple weeks back about the CEO sentiment. And this all falls in line with what we're talking about. But, as a consumer, we're scared because, hey, prices are fixing to jump. CEOs feel the same way. News media, same way. So we have this compression of opportunity. I was just looking, and golly, I've seen too many numbers today. I think what they're expecting is earnings growth of about a little bit north of 9% for 2025, which is not too bad. That's pretty dang good. Last year, I think we hit north of 12, which blew everything out of the water. But if we have the belief that feelings get in the way and mess everything up every single time. We know feelings are compressing our expectations for this year right now, and our expectations are pretty poor with a low 9.3%. What's going to happen? More than likely, our economy is going to be fine. We're going to have earnings growth a lot greater than 9.3, and if our economy follows, what happens to our companies that are a little bit on the cyclical nature?
It's the discounted companies that feel the best.
It's the discounted, yeah. So I'm not just talking my book. It just feels like we're artificially pulled down right now, and I just don't want to have that, golly, I wish I would have done this back then. I knew it, I felt it, we even talked about it, but we didn't do anything. I don't want to go through that. So,
Well, hindsight is 2020.
Every
is
time.
what they always say. And anytime that I'm talking with clients or just anybody in general about how the market has swung up and down and whatnot, is the problem when it goes down is people get scared. Like you said, it's a psychology thing. You see all the red numbers, you get scared, and you're like, well, I want to pull my money out, and it's that's admitting defeat is how I look at it. That's saying,
absolutely.
And and typically it's a simple physics thing, is what goes down must come up, and so it's going to, especially if you're, like you were saying, we're in quality companies that have been around, that have stayed around, that are not showing any kind of way of stopping. It's going to rebound, usually for the better. And so that's the kind of where I know that you've definitely, I can only imagine how many conversations you've had over the years of, yeah, it's down, but just hold tight, because as soon as you pull it out, you're not getting it back.
Over.
You have to wait it out.
Well, and if Henry were in here and had any charts pulled up in front of him the way that he does, he may say, well, Aaron, we're not too far from all-time highs. We've been, we're positive on the year, but we're not quite to our, I don't remember, was it February high?
Yeah.
And if you think about it, Henry would be like, I don't know, all-time highs, buying the market, all-time highs. Well, earnings have continued to grow since we met those all-time highs and since prior to that, but the price has still not recovered back to that point. So the market has broadened out. The prices are down from February. It's just a little bit more of a healthy market than maybe it was back in February. And if the tariff announcements and all the geopolitical stuff hasn't pulled the prices down, where would we be, relative to February times if you add 3 months of performance on top of it without those, what I would call hiccups in price performance?
I hope that was a theoretical question.
Mm-hmm. Most definitely.
But you're right, and I've said this a lot of times. Investing would be the easiest thing in the world if we weren't human. Our behaviors and our beliefs get in the way. I was looking at Hermes today, and it struggled last year, and we keep hearing that the consumer's gone. So I kind of look at that. I look at luxury and see what are the big boys spending their money on, and go look at revenues for that company. It's 4.9. It's increased 30% in this horrible market just since, I believe, 2019. And revenues are growing. People are still spending. Nobody's hiding under a rock. And we can see it in the actual numbers. So sometimes it would just be good if we were deaf, blind, and dumb and just didn't have to.
Let compound interest do its thing.
Yeah.
Well,
Exactly.
and then whenever you look at it, we have such a narrow mind as humans. We can only see. I mean, I don't even know what I'm going to do tonight. So just looking at the stock market in general, you're looking at it like you were saying in the past few months. It's done all this stuff, but if you look at it like in that long-term way that you've looked, like if you look back 10 years, like it's still going to have that upward slope. But of course, you see all the ups and downs, and so we live in the moment as humans, and that's not how investments work. You have to look at it as a long-term.
I was working with somebody the other day, and we're just looking at what the market's done over the last 10 and 15 years. And you back it up, it almost looks like a straight line up. So I don't care who you're talking to or what your risk level is. You show them that chart, and they're going to be like, yeah, I want that. There's no risk. It never goes up and down. But I think the cool thing is to take that same time frame and put it in, what is that, percentage off high.
Mm-hmm.
And you look at that, and, well, now you really see the moments, the points in time that you had to live through to get to that all-time high. And it's eye-opening, and you can't see it on a silly chart. But The good thing is we're always paid for the risk that we take. And we don't remember that the risk that we took in 2020, we don't remember the risk we took in 2019. That was yesterday, out of mind, out of sight. It's all about today. And folks, we've been through a lot worse in the very recent past. So what is it, the three monkeys? Blind, deaf, dumb, can't speak?
Yes.
This?
Yes.
It would be good if we could all do that from time to time, block this out.
See no stock, speak no stock, hear no stock.
Exactly.
Got it.
That's where I was going. Thank you, sir.
Yes.
I was thinking monkeys jumping on a bed. I have no idea what y'all are talking about.
Oh, gosh. Oh, you're living the good old days.
That's a whole different podcast
You're
later
still
tonight.
you're getting to tell that story.
Well, Kade, did you have anything lined up for us? I know you were talking a little bit before the podcast about some psychology of money style conversations, so I figured that, I'd be interested to hear what you had to say today.
For sure. So I've recently read a great book, Psychology of Money by Morgan Housel. Has some really good ways of looking at money and how we interact with it. And one of the things that really kind of stuck out to me was that basically the whole idea of that chapter was, do not compare yourself to people who are playing a different game than you are. Just like essentially we constantly compare ourselves to the big business tycoons who are doing the stock market, and they're making bukus of money because they're taking all these risky assessments, and people are like, well, why can't I do that? And the simple reason is it has nothing to do with your position. They're playing a whole different game. And so I know that whenever I look at my own money, my money is I want to grow it. So I'll put it one way. But whenever I look at a client's money, that's quality growth. I want it to grow so that way they have money at the end of the day. And so that's a whole different game plan that I have to have in mind when I look at my money and look at a client's money. And I think we as people compare ourselves so often to other people. And so it becomes that where we're constantly comparing ourselves to others, saying, oh, I wish I was them. And it's like, no, you can't think that way because you have a whole different set of circumstances, a whole different set of beliefs that you have to go into. And so what the book basically says is we have to close ourselves out from that almost and say, this is the game I'm playing. I have to stop looking at myself and wondering why I'm not ahead when someone else is on a whole different game plan than what I am.
Yeah, I love that. I've gotten so many questions of, should I take more risk? What are most people my age doing? And I'm agnostic to that. And if you've ever asked me that, you're going to get the same answer. If we let our emotions take over, the average investor makes 2%. 2%. So put that in perspective. We've got the rule of 72. You're doubling your money every 35 years.
Wow.
Yeah, 35 and a half years. And that's because market goes up. Hey, that's the best time to buy. Market goes down. We better get out. And we take our losses and buy at the top and then sell at the bottom over and over and over. And it's compounding losses where if we can get your risk right, in whatever that is. Let's say I can only handle half the risk of the market. Then we're in a 50-50 portfolio, 50% stocks, 50% cash or bonds, and you're making 5, which, man, that's not market growth, but we're doubling our money over 12 years. 12 years. So everybody is different. And our goal is to make sure you don't make 2.
Exactly.
Everybody's life is different. Everybody has different goals. And I was loving how you put that as you don't compare yourself to somebody else.
Yeah, you said you said people are asking you, at what age, or people my age, what do they do? And it's just like, that's just like if I asked you right now, well, the person that you talk to the most, that's the same age as me, is Sam. And Sam has 3 kids. I don't have kids.
Yeah.
So I have a whole different outlook of what I can do with my money.
You haven't
Sam.
told monkeys on the bed story
No,
in the last week or so?
No, I have not. Well, maybe Jasper. Probably told it to my dog. That's it.
That goes back. I was talking to a friend the other day, and he was asking me investment questions. And he said, well, why don't you just sell every time the market goes down about 5% and then buy it even if it drops another percent lower, and eventually you'll be beating the market. And so Aaron and I was talking with Aaron about it shortly thereafter, and we went and looked at it. And if you look at it on a monthly basis, the average volatility of the market's between 4 and 5%. So in that scenario, I mean, if you try to time the market, if you try to use specific tools and things like that, and don't trust the process, if you don't trust the long-term outlook, then you're just going to shoot yourself in the foot on a monthly basis by selling every time it drops 4 to 5%, and then buying it by the time it gets back even, hoping that the next time it drops a lot more so that you can buy it lower and make up the last trade. But if you're always trying to make up that last bad decision trade, I mean, you never catch back up, and that's where that 2% comes in.
Yeah. I thought that was so powerful that, hey, we know on a year-to-year basis your account's going to drop 18% or whatever if you're all in the market. But on a monthly basis, you should expect 4% volatility. Now, let's look at that from a business standpoint. If you're having to take 4% volatility on a monthly basis, should you not get paid for that? Absolutely. And that's the premium we get for being in the market. In order to take on that business risk, in order to take on that investment risk, which is big, we get paid big over the long term by investing in the market. But this isn't things we think about. We really think there's an easy button or a magic way to do it, and there's not. Take the risk, take the return. And over the long term, it works out.
Yeah, and over the long term, I think one of the things that gets overlooked so often and question that gets asked so often in response to somebody who's still trying to learn some of the things that we do is, well, what's your time frame? How long do you have? Kids have 18 years before college. Let's start the account now. But if you're graduating next week and have to spend, some of your account in 6, 8, 10 months, that's a different story than the day they were born.
Yeah. Yeah. If it's that short, you're rolling the dice. You're truly gambling, and sometimes it'll work out. But on average, who knows? Make smart decisions. You have wonderfully prepared, and I don't want to say educated, but people that have been through this so many times, and they can help you walk through on what market risk is and volatility and timing. And if it were my decision, and I know I'm going to spend some money in the near future, and I have it sitting in cash, wouldn't you want to do the same thing? Sometimes the risk just isn't worth it on the short term.
Well, and like you said earlier, you get the risk you pay for. You get the return from the risk that you have.
Yes.
And unfortunately, the problem with risk is it's not always a positive reward, quote unquote reward. You could just as easily get the negative piece of it. And that's the whole point of risk. And the biggest thing is that I've learned in my time with school and careers and stuff is there's always anytime someone asks a question, usually the answer is it depends. Like you were saying, there's always a time frame. There's always this. You may have 3 kids. You may have no kids. You may have a week before you graduate college. There's always going to be more factors than what you think goes into the answer.
Yeah. And I was going to say this earlier when we were digging into the behavioral piece. I think it's absolutely fascinating that when you listen to Warren Buffett, what is he telling his trust to do with the money? 90% S&P 500, 10% treasuries. There's no decision making there. You do these 2 things. What if the market's down? That's it. You're here. There is no behavioral screw-ups. And that's from one of the greatest investors of all time.
I think the most important investment rule is you invest it and throw away your phone and don't look at it for 10 years, and then you can do good.
If there was a secret sauce, if there was some magic trick, I guarantee Warren would have given it to that trust. But he said no, S&P treasuries. So keep that in mind from the smartest mind, one of the smartest investing minds of all time.
Do y'all have anything else you want to touch on before we conclude today?
No, I think it's good.
All right. Well, that is going to be another episode of Black and White Market Minute on Life Planning 101. Thanks, Aaron, and thanks, Kade, for tuning in today, and thanks to all our listeners.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.